Now, the seventh step is the closing entries. At the end of every accounting period, we do something very important like closing the temporary account. To understand this easily, imagine that every year your business keep a scorecard of how much you earned means revenues, how much you spent means expenses, and how much you distributed to owners like dividend. These scorecards are temporary. They are meant only for 1 year. You cannot keep the scores of the last year mixed with the new year. Therefore, these temporary accounts must be wiped clean and made ready for the next period. But before wiping them clean, their results must be transferred to retained earnings because retained earning is the real and the permanent record of the company's profit history. Temporary accounts includes all the revenue accounts, all the expenses accounts, and the dividend accounts. And these accounts show when what happened only during this period. When the period ends, their balances must be transferred to retained earnings so that the company's long-term equity is updated. On the other hand, the permanent accounts like asset, liabilities, and retained earnings stay open forever. They balance carry forward into the next period. That's why they are called the permanent or real accounts. Temporary accounts is the income statement account, and the permanent accounts are the balance sheets accounts. To make the closing process simple and organized, accountants use a special account called the summary account. Think of the summary as a temporary or holding area. First, all the revenues go into it, and then all the expenses go into it. After both are transferred, the income summary account will automatically show either net income if revenues were more than the expenses, or the net loss if expenses were higher. This makes it easy to update the retained earning account. When we close a revenue account, then we transfer their credit balance into income summary account because revenue normally have a credit balance. We close them by doing the opposite. Debit the revenue account and credit the income summary account. This brings the revenue account down to zero and moves the earning from revenue to the income summary account. For example, service revenue debited and the income summary account is credited. This clears the revenue account and send the amount to income summary account. Second is the we close the expense accounts. Expense accounts naturally have debit balances. So we close them by crediting each expense and debiting the income summary account. Opposite. This way the expenses are also moved into income summary account so the total can be compared with the revenue. And the example is suppose salary expense is the 30,000 and the real expense is 20,000 and utilities expense is the 5,000. To close all of them, then income summary account debited and salary expense, rent expense, utilities expense credited plus 55,000. Now all expenses accounts become zero. After transferring both revenue and the expenses, the income summary account now tells us the profit. For example, if revenues were 80,000 and expenses were 55,000, then the income summary account show a credit balance of 25,000, which is the net income for the period. This amount must now be transferred to retained earnings because retained earnings represents accumulated profit. For example, closing the net income summary account, if net income is 25,000, the entry is the income summary debited with the 25,000 rupees and the retained earning credited 25,000 rupees. If instead the company had a loss, then this entry would be reversed. Means the retained earning debit and the income statement summary account is the credit in case of the loss. Finally, we close the dividend account. Dividends are not considered an expense, so they do not go into the income summary account. These are simply distributions to owners. Therefore, they are closed directly to retained earnings. Closing dividends helps reduce retained earnings because the company is distributing part of its earnings. For example, closing dividends, if dividend declared were 10,000 rupees, the closing entry is the retained earning is the debited with the 10,000 and the dividend is the credit with 10,000 rupees. Now the dividend accounts also become zero. By the end of all these steps, every temporary accounts have been emptied, only permanent accounts remained open. Revenues, expenses, and dividend are now reset to zero, ready for the next accounting period. Meanwhile, returned earnings have been updated to include the results of the entire year. This whole process keeps the system clean, organized, and meaningful. And it's also help managers, owners, and the investors clearly see that what happened during this specific year and prepares the books for the next one with a fresh start. Now, next is the last step, and that is the preparing the post-closing trial balance. This is the final step of the accounting cycle is the post-closing trial balance, and this statement contains only permanent accounts such as assets, liabilities, and the owner's equity account. All temporary accounts now have zero balances, so they do not appear here. The purpose of this trial balance is to confirm that debits and credits still balance after closing entries. For example, cash account may show 42,000, supplies 2,000 rupees, accounts payable 4,000, and the owner's capital is the also 40,000. When we list there the total debits equal total credit, that is the 44,000. This means the ledger is ready for the next accounting period. And now the conclusion, we have now completed the entire accounting cycle, starting from analyzing transactions and ending with the post-closing trial balance. This cycle is a continuous process, and as soon as one period ends, the next one begins. Understanding the cycle is essential for preparing accurate and reliable financial statements. If you fully understand the logic behind these steps and practice journal entries, you will find accounting much easier and more meaningful. And thank you for joining the today's lecture.